If you were reading the news this past month, you probably also saw headlines like this: Turkey spent at least $7.3 billion propping up lira in December. Danish central bank made large intervention in DEC to defend crown peg. You probably thought, what is this currency intervention anyway? Hi, welcome to the channel. If you are new, please consider subscribing, so that you don't miss future videos. Remember to hit the like button just to motivate us to continue making these videos. By the way, if you are interested in making money online via trading etc., visit the links in the description box below. Let's get into today's video. Currency intervention, sometimes called forex intervention, foreign exchange intervention, is a type of monetary policy. This is when a country's central bank purchases or sells its own currency in the foreign exchange market to influence its value. Learn why countries choose to do this form of intervention and how it works. How does currency intervention work? At some points, a central bank feels like its currency is quickly appreciating, gaining value, or depreciating, losing value. This may be cause for it to decide to step in. It will conduct currency intervention to slow the movement. It can be used to influence movement in either direction. But currency interventions often aim to keep the value of a domestic currency lower relative to foreign currencies. Higher currency valuations cause exports to be less competitive. This is because the price of products is then higher when purchased in a foreign currency. On the other hand, a lower currency valuation lowers the relative cost of a country's exports. This can help increase exports and spur economic growth. If the US wants to decrease the value of the dollar, for instance, the Fed will sell US dollars. If the US wants to increase the value of the dollar, the Fed will buy more US dollars. To keep a consistent amount of money in bank reserves as it buys and sells dollars, the Fed will sterilize the intervention. This sterilization involves selling or buying bonds in proportion to the size of the currency intervention. Note that central bank currency interventions do trade large amounts of money. But the values aren't as significant in the scope of total forex trading. That means currency intervention doesn't immediately increase or decrease a currency's value. Instead, it signals the direction that a country's government is trying to push its currency, which may affect the decisions investors make. As more investors follow the Fed's movement, the currency value begins to shift. If you learned something new in today's video, please remember to click the like button. Leave a comment with your thoughts in the comment section below. Again, hit the subscribe button so that you do not miss future videos. We will see you in the next video.